Dear friends, season's greeting. Wish you all a very happy new year. As we close 2017, we are in an interesting situation. The fiscal deficit is increasing due to lower tax collections, especially monthly GST numbers have been below expectation. The crude oil price is on the rise and has crossed $67 as I speak. Domestic interest rates have moved up more than 100 basis points to 7.35% on 10-year benchmark gilt without any uptick in policy rates, even though US 10-year yield has almost remained constant in last 1 year. The IPO supply of equity paper is at all-time high, and yet our equity markets keep tasting new highs every day. 2018 will be a year of consolidation and moderation. We are unlikely to see disruptive reform like demonetization or GST, especially in the run-up to the general election. This will allow economy to benefit from the past reforms after bearing the brunt in last 1 year. The economy will continue to face the hurdle of overvalued rupee till fundamentals prevail over flows and high real interest rates till transmission of lower rates to borrowers, especially in small and medium enterprises, is achieved. Volatility will be order of the day for bulk of calendar year 2018. Headwinds are building up in the form of higher crude oil prices, lower GST collections, fiscal slippage, high real interest rates, and deteriorating current account deficit. Market towards fourth quarter calendar year 2018 will also witness uncertainties related to 2019 general election. Current valuations, which are priced for perfection, are getting supported by domestic flows. A large part of this domestic flows is coming on the hope of earnings recovery, but a reasonable portion is probably coming looking at past performance. Many of these flows are moving from debt to equity as interest rates have hardened in last 1 year. They probably believe that debt is risky and equity is safer looking at past performance. The majority of flows which are coming on earnings recovery will get some support in the form of lower base effect in December 16 and March 17 quarterly results. Those 2 quarters were impacted by demonetization, and it is likely that we could see double-digit earnings growth in December 17 and March 18 quarter because of lower base effect. However, eventually the economic momentum should pick up to push earnings growth to double-digit without base effect. It will be appropriate for investors to moderate return expectations in calendar year 18. They should also be ready to face volatility. They should also accept that stock picking will deliver return rather than broad sector call. The divergence in return between large cap, mid cap and small cap will narrow down significantly in calendar year 18 versus calendar year 17. One big theme which is worth relying not only in current year but also in years to come is disruptor versus disrupted. We are seeing technology and other forces creating disruption in business environment, and sooner than later it will start getting reflected into the markets. In every single company, in every single sector, you will see power of disruption. Not that every single disruptor company will be able to deliver return, but if you have more companies which are creating disruption rather than companies which are getting disrupted in your portfolio, that's likely to give market outperformance. The big theme for 2018 and onwards will be disruptor versus disrupted. In manufacturing, 3D printing and artificial intelligence is disrupting traditional models of manufacturing. In services, robotics is disrupting human way of providing services. There is no sector, no company which is outside the influence of forces of disruption. One will have to be very careful in evaluating future business prospects, as many disrupted companies will get extinct like dinosaur. When we are paying 20 times forward earning, clearly we are taking into account next 20 years cash flow and a terminal value. And if disruption is not going to be absorbed by the company, then they may not remain in existence over that period of time. So, disruptor versus disrupted will become bigger theme in the days to come. You need to have companies in your portfolio which are cognizant to disruptions. You want companies in your portfolio which are taking appropriate steps to ride on the wave of disruption rather than remaining subdued and getting disrupted. We continue to recommend asset allocation for investors. If you can follow Kumbhakarna style of investing, which is fill it, shut it, forget it, then lump sum investment in equity is fine. But we know that since Ramayana days, we haven't met any Kumbhakarna. And hence, for lesser mortals like us, systematic investment plan and systematic transfer plan will be ideal. You can choose large cap, mid cap, small cap, or multi-cap fund based on your risk profile. On a thematic basis, rural and infrastructure looks appropriate, keeping in mind the fact that in 2019 election run-up, government will spend more money on rural, agriculture and infrastructure sector. On the fixed income side, while fundamentally real interest rates are high, the demand and supply mismatch can keep yields elevated for some time, especially as inflation is on the up move. We recommend STP and duration funds like bond and gilt fund over next 6 to 9 month period with a minimum 3-year plus view for investors if they don't like credit opportunity space. For investors who can accept credit risk, credit opportunity fund will be more ideal as it is likely to be less volatile than duration funds. Hybrid funds will be an option for conservative investors. It is highly recommended to move first time and conservative investors, which is investors moving from bank fixed deposits in mutual funds, a hybrid scheme like monthly income plan or equity saving schemes rather than pure balanced fund showing past dividend track record. From mutual fund industry standpoint, we have our task cut out for next year. We have to manage investor expectations. While a majority of investors are coming reasonably well informed about the volatility of returns and need for long-term investment horizon, a minority indeed is coming looking at past performance. We have to caution them about potential lower nominal returns and volatility as equity markets are priced for perfection. Many investors tend to view mutual funds as equity funds, and we must market debt funds as well to them, and we need to do as good a job in marketing debt funds as we have done for equity funds, especially in retail segment. We need to stress on the need for asset allocation and longer term investment horizon. We need to keep on reinforcing the message of regular investment, especially to first-time investors in semi-urban and rural areas, so that they can share the benefits of equity return and won't get deterred by the volatility. We must drive home the fact that mutual fund remains a low-cost, value-for-money product for the common man. Wishing you all a very happy and prosperous 2018.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.